Hello everyone, it is the beginning of the fourth quarter here in 2019 and it's our time for us to give our annual quarterly update. My goal is to try to keep this in the 5 to 7 minute range for all of you here today. And so let's just dive in and talk a little bit about what's happening. As we're all aware, the market is at all-time highs or hovering right in that range, but it sure doesn't feel like it some days. We see a huge amount of negative news and bias around what's happening in the economy. We see constant articles or people talking about the next recession. I mean, everybody's coming out of the woodwork in the closet to try to be that person that times that call perfectly. At the end of the day, it ends up pretty much being all luck. But based on the facts, based on the data, it sure doesn't seem like we're going to see it anytime too soon. So we'll talk about some things that have happened in the last quarter. The markets continue to go higher. Interest rates were decreased. And obviously, we see a lot more things evolving when it comes to the political climate. And then lastly, we'll talk about the annual Social Security update as far as the cost of living adjustment. So when we look at the performance of the markets over the quarter and year to date, we can see that the S&P 500 is hovering right around 20%, actually 19.5% year to date. The Dow Jones is up 16, and if we look down at our friends in the NASDAQ, which tends to be a little bit more tech oriented, we see they are up 21%. Now, on top of that, because we've seen interest rates go down, our bond holdings have really shined here in 2019. So for those of you that are in our moderate allocation or even just our moderate aggressive allocation, you've seen a very, very consistent robust performance throughout this year because of our broad level of diversification. Really, the only areas this year that have been laggards are developing international and emerging markets, which in previous years have been some of our better performing asset classes. So overall, it pays to be diversified. It pays to have an asset allocation strategy. And for those of you that are working with us at Pine Grove, you're seeing and reaping the rewards of this. So one of the things that I've continuously shown quarter by quarter is how the market is valued and what's happening out there. And what you can see is that when you look at this particular graph is that we're hovering just above the 25-year average when it comes to price to earnings ratio, which is probably the most broadly used metric for determining value of the stock market. Now, the challenge with this is that because interest rates are historically so low, one would lead to believe that that may allow the market to be slightly more highly valued just because of the low level of debt exposure that companies have. That's why we're seeing so much consolidation and buyouts among companies because they can finance that so cheaply. It allows them to pay a higher price and still make a good earnings and profit on that. Now, speaking of earnings, what you can see here is to show further proof that the market deserves to be here is that quarterly earnings continue to shine, they continue to go up. We saw a little bit of a step back in 2018, but here we are in 2019, we're seeing those earnings continue to shine and continue to progress and trend higher. On top of that, profit margins continue to expand and grow too. So couple these two together with a strong economy, you have a recipe for success, which is why we're seeing the expansion that we have in stock market growth. Speaking of expansion, we can see that we've officially went over the longest expansion period in economic history. You see the average expansion lasts about 48 months and the average recession lasts about 15, and we've almost 3x that time period. We're at 123 months. Now, reversion to the mean or someone that would say it's getting long in the tooth, you can clearly make the case. But when you look over here to the right, what you'll see is even though it's been the longest expansion, it's been the slowest growing. So you could also make the case that, hey, this expansion is going to last longer because it's just not growing quite as fast as the last one. There's a lot of reasons. There's a lot of thought processes we could all go through here. But the reality is that we continue to make progress and expand as we go forward. Now, just as of yesterday, hot off the press, is that we saw our annual cost of living adjustment for Social Security increase for 2020 by 1.6%. So for those of you that want to know what this means for you, take what you're getting deposited into your bank account each month now if you're claiming Social Security, and add 1.6% to that particular number, and you'll see that's exactly what your number will be for 2020. Now, historically, Social Security has increased by about 2.25% on average. So inflation is a little bit lower than what we've seen historically, but it's still progress. Obviously, if you're paying close to what the Federal Reserve is saying, what President Trump is saying is that we really want to increase and ramp up inflation. Inflation is good, but at the same time, it's not where it's historically been. I think there's a lot of reasons that go into this. One would just be, from my scope, is that technology is making the world more efficient and more innovative, that we're really seeing prices being able to decrease in certain areas because we're cutting out different distribution chains and cycles along the way. But additionally, when you look at what inflation also does, it helps drive earnings growth, which now allows the consumer to have more money to spend. The good news here is that although we're seeing minimal growth in cost of living, we are seeing good wage growth across the board, and that's another strong indicator of a good economy. Lastly, interest rates were decreased once in the last quarter, as you heard. This is really more of how do we position ourselves in the global economy, not so much how we are positioned domestically. It basically what we're seeing right now is the Federal Reserve has sort of indicated that we may see one more decrease before year end. That's not for certain, but that's sort of what we're seeing in the landscape. Along those lines, the 10-year Treasury, which is really kind of the main driving indicator or correlation when it comes to mortgage interest rates, has trended near almost all-time lows again. And so what we're seeing is mortgage rates have really pummeled down to really the lowest levels we've seen since a couple years ago, which historically are the lows. So if you're someone that really has more than 10 years left on your mortgage, or you may be children, friends, family that have this extended mortgage period, I'd encourage you to at least go out and get a quote, at least go out and look at what the current interest rate environment will do for you. This doesn't necessarily mean go out and buy more house, but what it means is, hey, maybe there's a chance for us to put more money away faster towards the principal, or maybe even shorten our term because we want to keep our payment the same. So this is something that even in my family that we've looked at in our situation. So in conclusion, the market continues to be very quick in its recoveries. It tends to be very short-term oriented week to week based on what the market and what the news is saying, but it seems to be very, very resilient. Again, unemployment is low. The consumer is healthy. We're seeing wage growth. Across the board, economic numbers are really, really strong. So remember, as we start to hear more and more of this news about the next recession, the election, the impeachment, all this type of stuff, most of the time, the best decision to make is to do nothing. So remain patient. Reach out to us if you have questions or concerns. We're here to help. Enjoy the fourth quarter of 2019.